Again, one more round of applause for Eisner for hosting us tonight. Thank you so much for allowing us to be here. And with that, I'm going to turn it over to Paul Ellis to continue the program. I hope you enjoy this evening. Please let me know if there's anything we can help with. And again, thank you so much for making it out.
All right, thank you all. Welcome again. My name is Paul Ellis. I am the managing partner of the Paul Ellis Law Group. I also sit on the board of Tech Alliance, and I assist Andy with these series of events, the Foundations of Entrepreneurship. Just a few logistics. We are doing a video of this event. We have a slide deck as well that we're going to be using. If anyone would like to get the slide deck or to get the link to the video to see it when it comes out, please be sure to leave a business card. You can leave it with me afterwards or leave it at the front. I'll make sure that you get the deck, you get a notice of the video. Also, I keep a mailing list for these events. If you'd like to be on the mailing list as well, leave a business card. That's how you get on our list. Our next event in the Foundations of Entrepreneurship series is going to be an M&A event, March 26th, I believe. It's going to be long-term planning to get your company ready for an acquisition. So I think that will be of interest to a lot of people. It's focused on the steps that you need to take 18 months, a year out from an acquisition. That is to say, by the time you get a term sheet, there are a lot of things you usually need to have done beforehand to get yourself ready, to get ready for diligence, to get ready to employee retention, various other steps you want to take beforehand. This panel will focus on the long-term planning so that you're ready when you get that term sheet. Okay? I will, just a little bit about myself. Again, I am the managing partner of an 8-lawyer firm, Paul Ellis Law Group. We are located in Midtown Manhattan. We do a lot of work with early stage tech companies, formation, financing, venture capital, seed, friends and family. We also do work with employee equity plans, employment issues generally, strategic partnerships, intellectual property protection, and the various other issues that come up for early stage companies that are on a fast growth track. Our clients tend to be early stage companies as well as founders, key employees, as well as investors, both VCs, angel investors, family offices. With that, I'm going to tell you about our great panel. We have a really exciting group together. We have Meghan Cross of Amplifyher Ventures. We have Alan Wink of Eisner Amper, Tracy Caldwell of 1843 Capital, Sharla Grass of Greycroft, and Barry Oshero of Level 1 Equity. I will leave it to each of you to tell us a little bit about yourself and your organization. Meghan.
I'm Meghan Cross. I'm a partner at Amplifyher Ventures. We're a relatively new seed stage fund here in New York with the mission of getting more women into the C-suite of high-growth businesses. We're founded by my business partner and I are the early marketers and sales gurus from the likes of Facebook, Skype, Foursquare, and others from, I would say, the past generation of high-growth tech companies. And our mission is to support more female founders in this boom.
Good evening, everyone. My name is Alan Wink. I'm the managing director of capital markets for Eisner Amper. On behalf of the firm, I want to welcome everyone to our New York corporate headquarters. We're a firm of about 1,800 people, global accounting and advisory firm, offices throughout the United States, Boston, South Florida, Dallas, and west of San Francisco and LA. 6 international offices, India, Israel, Ireland, Cayman Islands, Singapore, and London.
Hi, I'm Tracy Caldwell. I'm the founding partner of 1843 Capital, 1843 stands for the year that Ada Lovelace wrote the first computer program, which gives a nod to the fact that women have been in technology a really, really long time. We invest in early stage technology companies with focuses specifically on enterprise software, technology for the aging, and cybersecurity. And I'm a recovering lawyer with a background in finance from Robertson Stevens and a former partner of Baker Capital before I started my firm. Recently, I was named to Entrepreneur Magazine's one of the 100 most powerful women in the United States, and I was extremely proud of that. And I told my sons, I'm one of the most 100 powerful women. And he looked at me and goes, yeah, Mom, but you're the #1 housewife.
I'm Sharla Grass. I'm a senior associate at Greycroft. We're really a seed to growth stage fund at this point, but I spend most of my time on our early stage fund, which is a $250 million fund, really seed and Series A focused. We typically lead or co-lead, but in many cases we don't have to. We're pretty flexible. Industry agnostic, offices here in New York as well as LA. We invest all over. Yeah.
Hi, Barry Osherow. I'm with a firm called Level Equity here in New York. We have offices in New York and San Francisco. I'm a partner there. We have approximately $1.7 billion of assets under management, and that capital is invested through 2 different strategies. There's the equity side of the house, which is the majority of the capital, and then there's the debt side. I joined the firm 3.5 years ago to launch and manage the debt side of the firm, otherwise known as structured capital, which you might see it in my title up there somewhere. But the entire firm invests in enterprise software businesses primarily. I'm writing checks between $3 and $20 million into growing software companies. So on this panel, I guess I'm a bit of an outlier since I'm not actually a venture capitalist, but I see a lot of VC-backed businesses. So I get to see sort of what happens to those businesses over time as they need more capital and as they look to bring in additional equity or debt type solutions.
All right, thank you all. So we have, again, great panel with investors. We have Alan, capital markets from the accounting side, does a lot of venture work. I'm a venture capital lawyer, so the idea is that as a group, we will break down this topic and answer all of your questions. So what are we going to cover today? Basically, today's panel breaks out into 2 sections. First, we're going to talk about what the market looks like today. We're going to take a look at 2019, how we did as a VC market, and what that means for 2020, although recognizing what the market looks like now is perhaps different from what it looked like this morning or what it looked like last week. So, but it's a moving target, so we'll do our best to tell you what we're seeing. And we're going to talk about trends for the coming year. So that's maybe the first third or so of the panel. Then, having talked a bit about what the market looks like, we're going to focus in on what you all need to focus on if you're trying to raise venture capital money. What are the strategies? And there's a list of things we're going to talk about. We're going to talk about how to identify appropriate VCs for your company, how to connect with VCs, understanding exactly what VCs are looking for when they are looking for potential investment opportunities. We're going to talk about the various pitch materials that you need, what they should look at, what they should include. We're going to talk about the first meetings with a venture capitalist and what you want to focus on. We'll talk a little bit about the early stages of due diligence, and then we'll talk about some of the common mistakes and how you can avoid them. So the notion is understanding a little bit about what the market looks like and about how to get to the term sheet will get you the first steps along the way. One thing that I think would be useful to the panel, just to have a show of hands, how many people in the market, how many people out here are with early stage companies or planning to start an early stage company? Can you just have a show of hands? Okay, that's pretty good. And how many are anticipating raising early stage financing, say over the next year to 18 months? Show of hands? Okay, good. That's a good percentage. All right, so we are going to start by talking about the state of the financing market. And with that, I'm going to turn it over to Alan.
Well, I think the good news is for the people in the audience who are looking to raise capital, there certainly is a lot of capital out there to be invested. Probably about $275 billion of dry powder is sitting on the sidelines waiting to find a home. So you'd think the frothiness of the market should continue in 2020 and beyond. But looking at last year, which was a great year, about $136 billion invested, down slightly from 2018, second highest year of the decade. Deal values are still way up at all deal sizes. We're still seeing a lot of mega deals or deals of $100 million plus continue to be quite common. About 40% of the VC dollars last year invested were in $100+ million deals. Last year was a great year for VC-backed exits. About $275 billion of VC-backed exits last year. First year were exceeded, $200 billion. And about 80% of the exits were from IPOs. So I think in summary, it was a really strong year last year. Frothy market continues, and unless the other panelists think differently, I think it's going to continue next year and beyond.
Should we go on to the next slide, or should we? Sure. Yeah. Okay, then we'll come back and.
As I said, I think 2020 will continue to be a great year. We've come through 3 or 4 years of very good fundraising by venture capital funds and private equity funds. A lot of dry powder, as I said. Deal values continue to rise. The one sort of wrinkle in this is the questionable performance of some of the recent IPO companies, where they still continue to lose lots of money. The road to profitability hasn't been well defined. There's been a lot of issues around corporate governance. So that could be a negative in terms of the future IPO market for VC-backed companies.
Alan, thanks. So I guess an initial question for the rest of the panel, clearly as Alan notes, there's a lot that's changed recently. The IPO market has softened somewhat. Profitability is suddenly back in vogue. Generally speaking, if you all like to give your thoughts on where the market is going now, what you're looking at for the next year.
I'll kick it off a little bit. I do think that in retrospect, we are going to look back at WeWork as a little bit of a turning point. This is my personal view, that so much money was being thrown at so many different companies, and business models seem to be put wayside a little bit. And I do think that after WeWork quasi-debacle, you might call it a full-on debacle, I do think that people started to look more critically at the business models, and are they going to work and produce cash over time? So I think with the benefit of hindsight, in another year or so, we're going to look at WeWork as a little bit of a turning point.
Yeah, I would add, in addition to the business model point, I think we're also seeing a bit of a turning point in terms of deal valuations and those pre-IPO valuations, which historically have been driven by software-type revenue multiples. And in the past few years, we've seen software revenue multiples applied to a whole bunch of businesses, whether they're in consumer tech, prop tech, something that's growing year over year the way a software business may have been, but the underlying metrics are not the same. So I think those two things hand in hand, both what Barry said post-IPO, but also that the point a company is sitting at prior to the IPO is seeing some of the letdown in the IPO market because expectations have really been tied to what is a different type of business.
I think sorry, this is well. Let's turn that off. I think the real answer is I don't know. I think that when you look at what's happening in the public markets today and the implications of coronavirus and if that should trickle down into manufacturing plants being unable to ship products, coupled with massive declines in valuations of the publicly traded companies who are typically a lot of the acquirers. And when you're trying to get an acquisition through one of these publicly traded companies and they're looking at where their multiple is trading these days, it's very difficult to do that. And so we haven't seen it trickle down into our valuations yet. People are still asking for crazy numbers. But I think that if this trend continues, we're going to have a wildly different market. But nobody knows.
Well, I think you brought up a really good point earlier, and Barry, we were talking about this before, but about profitability being the buzzword this year. And it's a term, like, profitability is all that on our side of the table, VCs are talking about these days, in that this novel thing of actually making money with a strong revenue generating business model is back in vogue, which is exciting, whereas in years past it was all about raising outside capital to infinity until you can create a data set of consumer behavior that in itself is valuable. Instead, we're now looking at clear-cut business models that have at least some visibility into profitability when listening at the seed stage. And as a result, we're, I think, in the next 5 years or so, we'll see a much more lucrative IPO market than we have in the past few, but also some more interesting M&A plays that are perhaps more so unexpected than the ones that we've seen in the past years.
Paul, just to add one more thing, another interesting, phenomenon of last year was you saw a lot of private equity funds be the exit play for VC-backed companies, which I think is probably to continue in the future because there's a tremendous capital overhang in the private equity, market also.
Except with the public market valuations where they're going now, the pension funds, their total pool of capital has shrunk substantially. And there's always sort of a tacit understanding with a lot of the large funds and the private equity funds don't draw down capital. They can't draw down capital, they can't make acquisitions.
So to bounce off of the point that Meghan made, if profitability is really going to be much more important going forward than it has been recently, what does that mean for early stage companies? Do they have to position themselves differently to access early stage financing if profitability is really what people are looking for down the line?
I mean, I would argue, I don't know about the founders in the room, but at the seed stage for specific business models, I would argue there isn't really that much of an immediate need. For example, if you're building some sort of two-sided or three-sided marketplace, it's still going to be pretty clear that you are going to burn some money to seed the marketplace. I think what we're seeing is certain business models where you really have to believe a cascade of miracles, 10 things going correct for a business ever to achieve profitability. That's getting harder at the seed stage, but I would argue for certain seed stage businesses, the story is still pretty much what it has been. There are some business models where you wouldn't expect profitability for several more rounds down the road.
Anyone else?
Yeah, just to key off of that, growth is still huge. If you're able to burn money but grow efficiently, that equation works in today's market, yesterday's market, and I believe in tomorrow's market. So as you're thinking about your own business model and the amount of capital that you're raising, it's about capital efficiency. Look, I like to lend to companies, so I love profitability over time or in the foreseeable future, but capital efficiency, I think, is even more critical, actually.
Let me point out we're we want to make this sort of an interactive presentation, so we're happy to take questions as we go. So, is there a question in the back? Mike? Yes, speak up, Mike.
Maybe I'm getting a little bit ahead of where discussion may be going, right? And that may be covered later on, but I'm just curious. I think you're talking about early and seed stage, where I think most of the people in this room are interested in. And I would put this question. I've run into a lot of clients that they say, I'm looking to raise $1 to $3 million or $1 to $5 million, right? And I've always looked at that as that's one of the toughest places to raise capital. Can any of you speak to, what can companies who are looking to raise, we're not talking about 5, 20, 30, 50, we're talking about earlier stage, greater than friends and families or angel or even early seed stage. Talk about, if we can, that area where companies are looking to raise that kind of capital. And what can they expect, and how should they be planning for moving forward?
So I actually think that's a really interesting inflection point for any business, in the sense that you have an ability to demonstrate product market fit, not necessarily in an obvious way, but in more of a creative way. And I'm always excited to meet with founders who can use the minimal resources that they've put to use already in order to show what they interpret as evidence that there is demand in the market for their particular solution. Meaning to say, you don't necessarily have to have real revenue, but perhaps more of a manual approach to getting beta customers to show that they're responding to a solution that you're putting out there and coming back to use it again. Obviously, every situation for a different company is its own. Another thing that I'll say, going back to the current financing landscape, that ties into that initial proper seed round is that there are different types of investors now. It's easier to be an investor than it ever has been, which is why you could probably walk down the street and meet 5 people in one given city block who identify as an angel investor. And at the end of the day, venture is its own asset class now, and it's particularly exciting to almost anybody who otherwise would have put their capital into stocks and bonds a few years ago. So what my advice would be to any of the founders looking to raise that initial tranche is try and identify those self-identified angels and those particular individuals who have relevant domain expertise, because they'll be the ones to get it first.
I think the term that's really important is validation. And the earlier that you can validate your business model, the better off you are in terms of raising capital. I'm affiliated with 2 different angel groups here in the New York metro area, and even for angel groups that are writing, $200,000 or $300,000 checks, they want to see some evidence of recurring revenue. I mean, it doesn't have to be millions of dollars. I'm talking, $80,000, $100,000. That validation is very important to them, even at the earliest capital stages.
I think one of the interesting things is we've had this huge influx of seed stage funds. 50% of the funds raised last year were seed stage funds to the tune of $9 billion. So the capital is out there. In terms of when you're raising between 1 and 3, what you have to do is do sort of a club deal with a lot of different seed stage funds. And obviously the best way to access those is to start asking everyone you know. And I always say there's gold in your LinkedIn account. If you just start with LinkedIn and email every single person and saying, do you know someone who's in the venture capital business? That's, I think, the best way to start.
I definitely agree with all of those points. Just to add something a little different, I would say particularly at that seed stage, I think people often lose sight of how important you as the founder and your team truly is. Because when a business is that early and you're just embarking on product market fit, a lot of times the most relevant thing for any investor is who you are and why you are best positioned to start something in that market, and who else you've attracted as a co-founder, a founding person on your team, etc. Ultimately, many of the biggest, most successful venture-backed businesses have changed quite a bit in terms of their specific customer, their business model, their price point, etc., from seed to series CDE. The thing that hopefully remains consistent is the founding CEO or the founders. So I think focusing on that, even before product market fit or when you're just embarking on product market fit, is something that early stage investors will certainly do.
All right, so I'd like to hit a couple more questions. What do you guys see coming? What's important over the next year? What are your funds, particular areas that your funds are looking at, or things that areas that you think are going to be especially important? Important trends. I mean, what's hot? I guess to put it in those terms. Anyone?
The area that we're most excited about is technology for the aging, and I've given it a name calling it silver tech, because this is the largest market opportunity there is. 83% of the wealth in this country is held by people over 50. It's where all the money is. So whether you're doing an enterprise software product into something that benefits people who are aging, or a consumer product that people who are aging will buy, this to us is the most exciting market by far.
Anyone else? Meghan?
Also along the lines of different stages of life, we've previously made a few investments that have been very long in millennials becoming new parents. Millennials who historically spend quite a bit are now entering a phase of life that has always required you to spend quite a bit. And then also the Gen X generation entering into the perimenopause stage of life. When we think about going to market and the different ways of spending cash, we also think about the people who are on Facebook and accepting and seeing those Facebook ads every day. And if you combine those two demographics, there are some interesting go-to-market strategies.
We are generally not thematic investors. We are more business model investors. So we look at things a little different. We get that question all the time, like what sort of vertical do you like? We just don't focus on it that way. We think that there are good businesses in mediocre verticals and mediocre businesses in good verticals. And so what we want, again, is those good business models and good operators. So it's not so much about what sector is necessarily hot, because there are hot companies in just about every sector, more or less. It's the way we look at it.
Ms. Cross, right? Could you expand a little bit on what you meant by talking about Gen X going into the perimenopause stage and how to reach them on Facebook? I kind of missed.
Oh, the connection there?
Yeah.
Sorry.
No, you're good.
So basically, if you think of the amount of dollars that are being poured into Facebook advertising, it's, first of all, we prefer to look at companies that are more creatively looking at ways to get around those high costs. But if you are looking at where people are receptive to different types of engagement and that particular choice of go-to-market strategy, that the demographic that is most engaged on Facebook right now is in that age demographic.
Yeah. Okay.
All right, so unless you all have any other observations on the state of the market, I'm going to move on. All right. Okay, so having said everything we have to say about the market, we're going to talk a little bit about how you all, as early stage entrepreneurs, how you go about the process of lining up venture capital financing. As I said, we're going to talk about the different aspects of that in terms of identifying VCs, understanding what they're looking for, getting your pitch materials together. As a starting point, I'll get to the right slide. It's a good place to start. Okay, so typical early stage investment instruments, just by way of, to set the stage, when we were talking about this as a group, we wanted to be clear what we're talking about. When we say early stage, we're really talking mostly about seed stage or Series A financing, largely venture capital financing. The instruments that we're going to be looking at, convertible notes, SAFEs, which is simple agreement for future equity, convertible preferred stock. It used to be that VCs were primarily would be investing with preferred stock. Lately, rules have changed, and there are a lot of different ways that investments get done, even by VCs. Common stock is not, that's what you all as founders have been issued, and that's what's used for your equity plan, but it's not generally used for early stage investments. Anyone on the panel, do you want to make any observations or on that point?
I'll just say that I think this is a really important issue because there's so many different structures out there. And I would just say as founders of companies or early stage businesses, keep an open mind when you're going out and raising capital. It happens very often to me where somebody will come into my office or I get on a phone call and they have their own way that they think it has to get done. And they're shooting themselves in the foot because they're so hung up on a particular structure because one of their friends told them that that's the way they should do it. And so I would just caution you to not get so pigeonholed into one particular structure. Keep an open mind. Consult with attorneys and and accountants, but and also talk to different investors. There's so much interesting stuff out there. Keep an open mind. Anyway.
I guess you have to remember, the popularity of convertible notes and safes are really a result of the fact that you kind of toss down the road the topic of valuation. So you don't have to worry about and ownership, because it really is just debt. They're not owners at that point.
Yeah. And that's why we don't like them. We really go out of our way to not do convertible notes and safes, not only because we like to know what our ownership percentage is, but then also too, one of the frustrating things is when those notes convert, there's all types of games that can be played, and it sets investor and founder against each other after you've already made the investment. So it's a really uncomfortable place to be, and we like to work together with our companies as teams and move forward rather than having that adversarial stance.
Yeah, as Tracy points out, and as I noted before, the world has changed in that regard. I mean, there was a day when a VC would not consider investing in anything other than preferred equity. There is some loosening of that, but generally speaking, yes, VCs are going to want to go into a priced round of preferred equity. But as noted, safes and convertible notes, they do have the advantage. They can be done quickly. They can be done easily. You don't have to deal with the question of valuation. It's very cost effective in terms of legal fees. There are a lot of advantages to those instruments for an early small round, but not necessarily for a VC round. So, all right. So let's move on. From this point on, what we're going to do, I'm going to run through the points of a slide real fast, and then I'm going to turn it over to the panel to take it from there to make their observations, war stories, color, and the like. So identifying VCs. So very important issue. When you know that you're going out to raise venture capital money for your company, how do you identify the venture capitalists that you want to approach? Because as you know, there are many, many. It's important to recognize VCs generally have a particular focus, whether it's industry, the amount that they want to invest, the development stage of the company. Many VCs, most VCs will have certain parameters or metrics that they focus on. And do your homework. You should know who you're talking to, because otherwise you're wasting their time and wasting your time. If you're you know, if you're a social media company and you're going to, what do I say, a fintech investor that does fintech investing, you know, why bother? So, you know, do your homework. Fortunately, there are lots of resources out there. Online listings, go to the VC's websites. They'll tell you on their website exactly what they're interested in. Although, you know, I'd also say, at the same time, you know, to some extent, there are certain VCs that are opportunistic. And if they see something they really like, even though it's outside of their area, you know, maybe you get their interest. But nevertheless, focus on what they say they're interested in. VC attorneys and accountants can help you identify VCs that are appropriate for your company. VC fairs are a good way to learn about VCs and to meet VCs, although they often will cost you a little bit of money. Networking events like this one, you know, $15, what a good deal. And other entrepreneurs, you know, within your network, you know companies, you know people that have gotten VC money. Talk to them, especially a company that's like yours. Find out who they spoke to, see who invested in them. That's a great way to learn about potential VCs. Last point: know who, you know. Consider not only who would be, you know, who invests in your sector, but, and we'll come to this a little bit later, you know, understand how they operate, because it's not just about the money. It's about everything else that the VC can bring to your company, contacts, credibility, and the like. That all matters, and it can be very important. If you all would like to add to that?
Yeah, just one specific point on the VC fairs point. I know that at Greycroft, our entire team and a couple other firms that we're close with, there's a couple fairs or events out there where entrepreneurs can be charged several hundred, even low thousands of dollars for meetings with venture capitalists. We, as a rule, do not attend those, and we do not want our logo or our team to be a part of that. We just don't think that's the right use of a CEO or a founding team's money at all. So that's one thing to put out there if you're considering something that seems a little too expensive on the VC fair side. It probably is not the right type of event.
Also, a lot of times, some of those particular fairs put logos of VC funds attending that aren't actually attending. Mm-hmm. So really hold on to that cash that can be spent on growing your business. Oh, and also I will say one thing about this slide too, is that I think it's oftentimes very easy to forget that fundraising is a two-way street. Like, it's our job to meet you as well. So at the end of it, like, we're also actively looking to meet with the right founders for us to invest in. And capital is a commodity in itself. So when you're actually out there fundraising, it's very important to look to the investors on the other side of the table and see what they bring in addition to the actual cash that they're investing.
I'll make 2 points. One is that this is also a people business. You really want to try to connect with the people. That's critically important. At the end of the day, getting to a deal, while spreadsheets are important, the reality is that your investors are generally part of your board. You have to work with these folks, and they work with you. They're really, you want to establish a relationship. And I think that's really important, and some entrepreneurs overlook that. That's number one. And number two, I do want to echo one point that's been made, and that is fit. You don't walk into a Bed Bath & Beyond and try to buy a pair of sneakers and walk up to the manager and try to convince them why they should be selling sneakers. You've walked into the wrong place to get what you want. It's just not the right fit, and no matter how much you try to convince them, they're not going to just start selling sneakers because you want sneakers at that moment. So it's really important that you've done your homework and gone into the right place for the right type of capital for your business.
Just a quick note on that. Many firms will have a page on their website showing a lot of their portfolio companies. There's also other resources out there to find some of those things. It definitely can take time, but it's usually worth at least checking that out because you can pretty quickly get a sense of what type of businesses a firm does or does not invest in by checking out their existing portfolio companies.
So one of the things that we're accused of all the time is that VCs don't want to meet you unless you come through a trusted source. I had a hairdresser say to me one time, they treat you how they meet you, which is very apt, and it's true. If you come through a trusted source, it's not just a cute thing, it's not something that we're lazy, we only want to meet people through other people we know, but it's also a trust factor. You know, when every time when I do the confirmation on the wire transfer, I think, oh my God, there goes my investor's money. And when I was at Baker Capital, we had a company come in and we funded them with $30 million, and 2 months later, they were an overseas firm, they were gone. Not returning phone calls, nothing, radio silent. There's a tremendous amount of fraud in this business, and so establishing a relationship with a firm or coming through a trusted source shortcuts that trust factor, which is incredibly essential. And as for our firm, we always do background checks because of that as well.
Yeah, I think I'd underscore, generally speaking, I mean, I'm a VC attorney, so it's something I focus on, but I know that I and other VC attorneys and people like Alan, that, you know, in the accounting space, we often have access, we know a lot of VCs, and that can be a very good way to get a connection. Because, you know, that, as Tracy says, that's a, you know, helps to get you past that trusted source hurdle, which can be very important. So let's, yeah, question here?
I'm going to ask for the panel, so what are some of the qualitative things that you look for in a founder? And second question, how important is business culture when it comes to scaling up a early stage business?
So in terms of the qualitative aspects of a founding team, I think, you know, success breeds success. So one of the things we look for is, were you successful in your past endeavors? If you started 4 companies and all of them failed, it's hard for us to get over the belief that the next one is going to be successful. It's also to having experience in the space that you're doing business. So it's very difficult for us when we see someone who comes in and, oh, they were at a consulting firm, but now they're going to start something in the fintech space. That's really hard, because if someone has experience in their space, they're going to be well connected and well networked in terms of gaining customers, in terms of already having relationships for other sources of funding, and for just a general better business knowledge. But then in terms of culture, sure, we look for people that are getting along. And body language, I think one of the great things that women investors are good at is picking up on body language between founding teams and making sure that they are connected, because it is tough. And, you know, so often we see co-founders split up, but we don't like it. So it's good to see a good connection with your co-founder if you have them.
I think what the questions that you've asked are very astute, but very difficult to answer, because it's really hard to find exact consistencies across different management teams, because so many different people can be very successful and they can all be very different. So on the one hand, it would be great to be able to say, here are the characteristics of a successful entrepreneur, and you know it when they walk in your office. The reality is that they sort of take a lot of different shapes and forms. Years ago, I did a deal with Carlyle, and they spent an enormous amount of money, hired one of the best consultants in the world to assess the management team of this company that they were buying. And the management team came back with all A's, A minuses, great, 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 great. They put a ton of money in it. Guess what? Within 6 months, they had to replace the entire management team because they're a bunch of goofballs. So, and that's Carlyle, one of the biggest, most well-known private equity firms, all the resources at their fingertips. So I think it's really hard. Personally, I like, when I'm talking to a management team, an entrepreneur, domain expertise is critical. You really understand your market and what you're doing. Confidence without arrogance is actually something that I personally gravitate towards. When people come in and are just overly arrogant about their business and knowledge, I personally find that a turnoff. Maybe other investors like that. I don't know. I don't know that one is a proxy for entrepreneurial success, or not necessarily. But I know I have to work with that individual and their team. in terms of culture, I do look for how that entrepreneur interacts with the rest of their management team. If they bring an entourage with them and nobody else speaks and just one individual does all of the talking, that is a turnoff, because have you compiled a management team that you trust and believe in and you can hand off the reins? Is it a collaborative management team, or is it a dictatorship and you just like the bios? And so I think being able to articulate the vision along with the management team and show that you've really compiled a smart, intelligent group of capable people around you and given them an opportunity to exhibit that is important, and it shows you that you have the confidence as a leader to hand off the reins as well a little bit. I've babbled long enough on that.
So one thing on that last slide, oftentimes, especially at the very early stages, when we give an entrepreneur feedback that we are not going to invest in their company, their next email to us is asking if we know anyone else who might be interested. I would say that's probably not best practice. In general, if we're making a connection to another fund or another investor, their first question to us is going to be, is this something that you're investing in? So I would say it's always better to try to find another mutual contact, an advisor, a lawyer, etc., rather than a firm that maybe you've had, or an investor that you've had one meeting with and is not getting there in terms of your investment. The flip side of that is we often will go out of our way if we are excited about something and it's just not in an area that we're investing in, or it's a little too early. We will proactively, with the entrepreneur's permission, mention it to other people in our network. I would just be careful about specifically asking for that if it doesn't feel like you have a deep relationship with that person.
One of the other issues here, there's an old adage in this business, sometimes when you ask for advice you get money. Sometimes when you ask for money, you get advice. So, don't be hesitant of asking, your VCs for advice, especially when you're starting out in this process. Very early. Don't hesitate about asking for advice, because you might get money out of it.
All right, so we've touched a little bit on this. So what are VCs looking for? When a VC is taking a look at a company, evaluating it for potential investment, what are the things they're going to focus on? Well, there are a number of factors. Every VC is going to look at these a little differently, and for different companies, different factors will be important. But among the important factors are a large and growing market, a proven management team, or at least a management team that inspires confidence, a technology which is preferably disruptive, a product or technology which is protected or hopefully protectable, or some other barriers to entry, and as someone noted, some indicia of market acceptance, like revenues. Keep in mind that, and I say this all the time, remember that your company is being evaluated as an investment opportunity. So don't focus over much on the product, on the technology, on the service. That's important. You need to make sure that the investor understands what it is you're selling or what it is you're trying to create, but that's not all that matters. What matters especially is how are you going to make money for that fund? How is that fund going to distribute returns to its LPs? Along with the technology, focus on the business, how it's going to make money, and how much, how the VC is going to make a return out of it.
I guess the shorthand version of that is management, market, and product, right? What is the big opportunity? What's the big problem that you're solving? Why are you the team to solve this particular problem? And is this solution the one that makes the most sense? And the way to actually make those three bullets come to life a little bit is by telling a story, a very concise story preferably. And coming into any meeting with an ability to educate and have command over the domain and the material that you're about to share. more or less generalist VCs, we'll speak for myself. We love learning and we love coming into a meeting and leaving with a whole slew of fun facts that are thanks to the management team that has just presented an investment opportunity. So because you as the founder are the expert and you are the only person in the world to solve that particular market problem, it's very important to be able to tell a story in which you're educating the person across the table. It kind of hits on all those.
Anyone else?
I think of it a little bit as everybody's seen Shark Tank at this point, right? And that's a lot of people's frame of reference as it pertains to this approach. And the reason why I talk about that is because sometimes you like a company, you like a management team, you like product, you like everything about it, but you hate the deal. And I think it is important, as Paul mentioned, we're all in this as capitalists. We want to make money, right? And so we need the opportunity to make money out of the deal. So you may walk into our office and talk a great talk, and we like it, and then you're like, okay, well, I expect, a $200 million pre-money value, and you're like, well, that makes no sense. You have less than $1 million of revenue, or whatever it is.
Yeah.
And so you're like, I love the company, I love what you're doing, but the deal is horrific. So best of luck to you. So you've got to be a little bit realistic. Just anecdotally, funny enough, people think, us New York capitalists are pigs. The reality is that I was talking to a company yesterday where the guy was raising money, raised $12 million for a $5 million revenue business, growing at 8% per year at a $200 million value. And he was taking that money from angel investors in Florida and Texas. He was scamming them out of their money, in my humble opinion. And people talk about us New York capitalists, and it's like this was a company in Montana that was doing this. And so I use that as an example by saying, when you're going out there raising money, equally important as the product and the market and all the things that everybody's talked about, those are important. You also have to think about what is a reasonable deal for your investors to make money. Everybody needs to hit their return thresholds. Otherwise, it doesn't make a difference how good your product is. So, we try not to be piggish, but I would say you try not to be piggish too.
All right. Is there a question?
Yes. So these are good pointers, but one question I have for these is purpose, right? Profitability, product, those things are probably easy to explain. I also have a purpose in terms of community or certain areas like women in specific sectors. How do you guys value that as a part of the overall package, right? If I come sell an idea, but I have a product, I have a great idea, I have profitability, how much you look for purpose or community or those kinds of other key things as well? What is the weightage to that?
You need to find dual bottom line investors. That's what they're called, in my humble opinion. It's dual bottom line. They have a dual mission. It's capital and profits, but also a secondary mission in mind.
Yeah, there's a request to repeat the question. It's purpose and mission and other social objectives. How do they fit into the analysis of the VCs? Is that correct?
Yes. Thank you.
So we're fiduciaries for our investors. So first and foremost, it has to make sense as an investment for the fund. But then there definitely are, once you get over that, it's always a nice plus if there's a diversity on the team, if some of the board members are diverse, if the mission is good. I have a saying that, first do no harm. So we would never invest in something like Secret or Jewel or a company like that. But as long as the company makes financial sense, then if it has those additional factors, it could push a company over the edge versus another. Because we saw 650 companies last year, and we're a tiny fund. So you guys must see like 4,000. So in order to sit through all this, there's much more competition out there than there ever was. And those factors are good, push you over the edge factors.
Because that's also kind of a differentiator, right?
Yep.
Because core thing is your product and your profitability, but also these are also one of the differentiators, which at least I will look for at a VC to align in terms of purpose. Okay? But thank you.
Yeah.
there are a lot of economic development programs out there. I don't know what the dual bottom line is that you're specifically referring to, but I've managed dual bottom line funds in the past that are tied to economic development programs that are set up for job creations in certain states, et cetera. So you can look for those different types of vehicles out there. That capital, when you can find it, is some of the best capital out there. Because if you're sort of hitting that dual purpose, you get to raise the money at basically a better value for you as the entrepreneur, if you can find it.
There's a whole group of funds out there that are considered social impact funds that are looking for that extra purpose in addition to capital appreciation.
Pitch materials. We'll talk a little bit about what it is you need to pull together before you go and meet with your VCs. Generally speaking, this is what I tell my clients they should plan to have ready. They should have an elevator pitch, which is basically, whether you deliver it in an elevator or, at a networking event like this or wherever it is. What that really means is you need to be, it goes to Megan's point about telling a story, you need to be able, in a couple of minutes, explain what it is you're doing, grab the attention of the VC, and get them interested enough to want to learn more and understand what it is you're trying to do, why they should be interested in your company. I recommend you should have a short description of the business, basically a written version of your elevator pitch. When a company comes to me and wants me to introduce them to a VC that I know, what I'll usually tell them is, I need an executive summary and I need 1 or 2 paragraphs about your business, because I want to be able to forward that on to a VC, and I don't want them to have to open up a document. I just want them to have to be able to read in my message, here's the company, here's the opportunity. Because if I make them, have to open up a document, that we may never get that far. So, it seems simple, but 1-2 paragraphs should tell the whole story. And I'd say for both of these things, the elevator pitch and the description of the business focus on the best stuff. Every company has things that it's has going great for it and things where it's still working out the details. But if there are things about your company that are really killer, like if you've have lined up the key partnership in your industry, or if your advisory board is the dream team in your industry, or if your revenues are growing 50% month over month, or whatever it is that is going to get the attention of the VC, that should be the first sentence or the first couple of sentences. An executive summary, a page, a presentation deck, not very long, 10, 15, 20 slides at the most, maybe. And if it makes sense, a demo. But these, I'd say, are probably the key elements. Generally, these days, you are not going to need a business plan. It's probably not going to get read if you have it. Nor, for the type of investment we're talking about, are you going to need a PPM, or private placement memo. Further thoughts?
Actually saw PPM the other day. That was very funny.
Kind of funny, huh?
Yeah, exactly. It was funny.
I also think a couple of these, not a couple, a demo or maybe product screenshots or mock-ups or something, I would save some sort of nugget as a reason to follow up. So say you have an initial meeting where you do walk through a pitch deck. The expression in networking, the goal of any conversation is to have an excuse to have another conversation. Have something to follow up with, and as a reason to have that subsequent call action.
I think it's important to not make things overly complicated, particularly in your first meeting. Anecdotally, I think it's always helpful to tell a little story. One of my former partners, he was head of research at Merrill Lynch for software businesses. This goes back a few years. We had a company in our office, and they're pitching it, and the financial statements were very complicated. And this entrepreneur was like, oh, it's very complex, and I have to explain it all to you. And my partner, maybe a little bit rudely, but the point is made that he's like, well, I used to cover Microsoft. And Microsoft, I'd have a P&L, a cash flow statement, and a balance sheet, and I pretty much knew what was happening at Microsoft through 3 pieces of paper. And you, as a little tiny company, you're telling me your business is far more complicated than Microsoft? That's hard to imagine. A little rude, but the point is that you want to keep it concise and tight. That is important in the first meeting.
On that same point, in terms of having a presentation deck, I think anyone around the table would rather see 7 or 8 really clear, well thought out slides than 30 or 40 slides, especially in your first rounds of fundraising. There just really isn't a need for that, and it's going to invite more questions and frankly isn't a good use of time, especially if you're pre-product or pre-customer. There's just no need to have more content.
You know, when you have this opportunity for an elevator pitch, if there's something really special about you and your team, for example, this is your second startup and you had a very successful exit the first time around, make that known in the first couple of sentences. Get their attention.
Can I just take a step backwards as well? Because before you pitch, you should ask the investor what they've invested in, what are they interested in, what's a hot area of focus for them right now. Because as you ask them some questions, first of all, back to your point about humanity, it's just you're having a relationship and a conversation with another person, not just a checkbook, that they'll tell you what they're looking for, and then you're better able to tailor your pitch when you get to your pitch. But then the second and much more important reason why you need to do this is because if you talk first, the other person is going to be thinking the whole time about what they want to say, and they won't listen to you. So have them talk first, get everything out that they want to say, because we want to tell you about our funds. We want to tell you about what we've done in our backgrounds. So let them talk first. You'll get much better.
Especially if someone has told you that they have an interest in that market. I always like when entrepreneurs ask me, oh, what else have you seen, or what specific sub-space within that huge industry are you most interested in? Because that answer really saves you a lot of time, and then you can tailor right off the bat your pitch toward that interest. And if they tell you, this is a crowded space, we've seen 10 of these, you can figure out what they've seen, and hopefully you have a compelling pitch about why you're different than all of those 10 that they've seen and passed on already.
Yeah, one other thing to be careful of is every entrepreneur thinks that their business is so unique. All we do in my firm is look at software companies all day, every day. And every once in a while, not every once in a while, frequently actually, I'll meet with an entrepreneur who is trying to explain to me about a SaaS business and how it works. And they pay up front, and so we get cash up front. And no, I get it. I understand. Now you got to move on. No, we're so unique. This is how we get 1-year contracts and they pay up front. And it's like, no, I know. I've spoken with 8 other companies today that said the exact same thing. So I do think you need to think about how unique you really are, and also your audience. If that's like for us, we look at software companies. Assume we have some embedded knowledge of looking at software companies. That's it.
Yeah, question?
What's the right time to approach the VC, especially for firms who try to solve for a two-sided market and just trying to acquire customers, don't have a revenue model yet and so forth?
What's the right time? You mean like Saturday morning? Or, because I'm serious, it's actually a good time.
Right stage, right? Do they need to focus on acquiring a million customers and proof points before you can put up VCs? Or?
Yeah, so I think this goes back to something we spoke about a few slides back, but each firm or investor group or angel group really does have a different focus. And someone said something It's not worth convincing a Series B fund that they should take a chance on you, a pre-seed startup. That conversation is not going anywhere. So I think, one of the most important points on this slide about finding the right VC is you want to find someone who is comfortable with the stage that you are at. There's just no benefit for you to try to stretch to a fund that only looks at leader companies, because there's plenty of options earlier on that are also better tailored to help you out.
There's a fund for every single stage. Sorry, I'm sorry.
There's a fund for that. Is the new app for that? Yeah. Assuming that you're in the first stage, or the first institutional stage of financing, I would just say rule of thumb, 6 months before you actually need the cash, and when you start to understand what exactly you could use that capital for. Use of proceeds is often a very use of proceeds is really important to talk about, and when you're talking to an investor, you want to be able to show, not just because that's where the capital is going, but it's more importantly to show your vision for the next 18 months of the company and how you get from point A to point B. So to answer your question, 6 months before you need it, and at that time, starting to think about exactly how you would use it in order to get to the next stage too.
And also along the same lines, not only you have to understand how you're going to deploy the capital you're raising now for the next 12 to 18 months, you should have a pretty good idea of what you're going to need in the future, especially if you execute upon your plan. So you want to see that sort of that cash flow going out a couple of years at least.
Don't come in showing a chart of how you're going to grow faster than Google. I have literally had people in my office doing that, and I'm like, seriously? I suggest you not do that, even if you believe it in your heart.
I saw another, yep.
Yeah, how important is it to have, in the context of between this stage, a super well-developed Excel model as opposed to those other things? I spend a huge amount of time making sure my model is up to date every month, and I wonder sometimes whether that's what I should be doing.
I love this one. Your model is all wrong. I'm sorry to tell you. I haven't even looked at it yet. But one thing I know for sure is that reality will play out differently than what your model says. So move on to other things.
But like, if you're going to share your model, the fact that it's up to date is really good.
Yeah. Another question here?
We have a software platform and a service business. The service business is using the platform as an advantage in the market where we have clients and some traction. Do you prefer to see separation of the two companies? And would we be better off being valued as a platform that has comparable sales in the industry?
I think it's sort of an urban myth that we only invest in recurring revenue software businesses. And we've seen some of the greatest success stories be a combination of product and services. And I think that they complement each other very well. When you switch to when the product is outselling the services part of it, then your multiple for your valuation of your firm is going to change. But it would be my suggestion that you keep them together.
We've touched on a little bit of this before. We're going to talk about the first meetings. We'll pick up whatever we haven't already talked about. One thing that I often recommend to my clients, they may have 3 or 4 VCs they're interested in, they're trying to line up meetings with. The 1 or 2 VCs that are really the best prospects for them, don't make those your first meetings. If you can swing it, meet with at least 1 or 2 of the other funds first, because every time you meet with a VC, they're going to ask you questions. You may be ready for some of those questions. You aren't going to be ready for all of them. And every time you meet with someone, you're going to have your pitch down a little bit better. You're going to have thought through some of the tough points. You'll be able to present a little bit better. So if you've got 1 or 2 VCs that are really your best prospects, push those off a little bit. Get some experience under you. You just get more comfortable pitching if you've done it once or twice. Be aware of the level of the person you're meeting with. whether they're more junior or more senior, or more technical, tailor your presentation. And it's been said here, be prepared, do your homework, know who you're talking to. Tailor the presentation to the audience. Keep the deck short, that's been discussed. An important point, focus on how the VCs are reacting to your presentation and the question that they're asking. That's valuable information. Listen to their questions, understand what they're getting at, answer it carefully and thoughtfully, and make a note of it. And you may want to incorporate that into your presentation the next time, so that whatever the question was that they asked, you answer it up front. And lastly, don't play hide the ball. Face the tough questions directly. And I say to people, if there's a tough question out there, I recommend you get it out there first. You make it part of your presentation, because you can be sure in almost every case, the VCs have in most cases, been at this a lot longer than you have. They've seen a lot more companies than yours. They'll know the tough questions, and they will generally respect the fact that there's a difficult issue. There's a difficult issue that you have to figure out in order to make your company successful. Be upfront about it. You say, we're still trying to figure this point out. The VCs will respect that, and will respect that you're being honest and forthright, and maybe they'll help you to solve it. Thoughts?
One issue, when you go into a meeting, don't have an expectation you're going to spend 2 or 3 hours in that meeting with that VC. Assume you have probably 30 minutes. Maybe if it goes really well, you get 45 minutes to an hour. You're not going to have all afternoon, so make sure your most important information is in the first 10 minutes of that meeting.
It's been statistically proven that people can only retain 7 concepts in their head at a time. And when people want to work through every single detail of their business, it's very tough for me. And everybody's different, but one of the things that I found incredibly awkward lately, and I've seen this a couple of times lately, is where someone is essentially giving me a dissertation, and then they say, I will stop now and pause for questions. And I think, well, you put me to sleep and I forgot what my question was. So I think it's important to just pick 7 points that you really want to cover and take your time going through those and don't talk too quickly. Really engage with the other person.
One little trick that I actually use too is I only talk for, I probably actually haven't done this panel, but I try and only talk for 90 seconds at a time before actually coming to and trying to see if the other person is engaged, has a question, or even if you just use the question inflection at the end in order to make sure the other person is engaged. So 90 seconds. I'll stop there.
That was about 90.
I would say at the point where you're actually in a meeting with an investor, you should have a pretty good idea of what you're looking to get in terms of fundraising, in terms of amount, timeline, etc. It's really fine if you don't have it figured out exactly yet, but I've been in a few situations lately where the founder is at the point where they're having a full meeting with us, but they're still kind of asking us for advice on what they should be raising, which is fine. We're happy to give our thoughts and advice, but you don't want to come in completely cold as if you haven't given a thought to how much is appropriate, what the use of proceeds are, etc., because you're asking someone in a first meeting their thoughts. We want to be comfortable that you've thought a lot more about it than we have.
7 thoughts, that's pretty good. I think my wife would say I have the ability to retain 2 at a time. I would reiterate one thing, and that is answer the questions that you're being asked. This is a pet peeve of mine, that people think they're guessing where I'm trying to go with something, or they're just trying to figure out, they're playing a different game in their head than what I'm trying to get at. And if I ask a direct question, I just want a direct answer. I don't want 10 paragraphs leading up to not even answering the question. So for me, that's an important element.
Then we get on to diligence. So you have gotten past the first meetings. The VCs are interested. They're going to want to take a deeper dive. Now, diligence is a process that begins when the VC has at least some degree of interest and continues until the deal is signed and closed, basically. Although different things happen at different stages. Generally speaking, diligence begins before the term sheet, at least at a high level, and then, as I noted, continues on. It starts at a high level and becomes more detailed and more focused as the discussions continue and as you go into documentation and towards a closing. But at the beginning, they really want to understand at the big nuts. They want to understand what your technology looks like. They want to understand your business plan. They want to understand how sort of the fundamentals of what you're trying to do, what you're trying to put together, who the team is. They're going to take a much closer look at your finances, at your spreadsheets, at your financial assumptions. Generally speaking, as I note in the third bullet, every startup company has issues. I said this before. Don't try to avoid yours. As I say, generally speaking, disclosure is your friend. Whether it's in the financing world or the M&A world, you want to get the information out there about your company. You don't want people saying afterwards, "Oh, we asked you that question, and you didn't really give us a straight answer." To Barry's point, whether it's in the first meeting or it's right before closing, if you get a question, give people a straight, complete, thorough answer. You don't want them coming to you after you've closed and say, "You weren't telling us the truth," because then you've got a much bigger problem than not having closed your investment. Your time is a valuable resource. Most investors their time is valuable too, and they're not going to want to waste their time or your time. But you need to feel confident that the process is moving forward towards, systematically towards a closing, or at least in a constructive way. And if you feel as though it's becoming a waste of your time, and you're not sure whether the investor really has interest at the end of the day, then you may need to be upfront because you spend a lot of time on diligence. You spend a lot of time trying to raise money, and that's time that you're taking away from building your company. So that's time is a resource. Use it judiciously. And finally, remember that diligence is a two-way street. At the same time as the VCs are diligencing your company, you should be diligencing the VCs. You want to look at the other companies that they invested in. You may know some of those founders. Speak to those founders. How did it go for them? Are they happy with with that partner, that investor as a partner? That should be happening at the same time as they're looking at you.
I think especially at the seed stage, probably the most important point is the team, and then also doing diligence on the actual fund. So we do a lot of both on-list and off-list team references. It's usually not that hard, especially for a New York-based company, to find someone that has worked in some sort of capacity with all of the members of the senior team, and what they have to say is usually pretty useful. And on the flip side of that, especially if you're not familiar with a venture fund, it is really important to do your diligence as well. We give all of our companies that we're seriously considering investing in a list of all of the contact information of every CEO we've ever invested in. Obviously, no one is calling hundreds of people, but I wouldn't be afraid to ask for that, even if you don't happen to know any of the portfolio company CEOs. Someone should be willing to help facilitate references for you.
like maybe like one notable instance pushed aside a company or investment that y'all were pretty invested in because of like the references that you got?
Yes.
Is there like something that comes to mind, something that was really specific or that stood out?
Yeah, so I've experienced this a few times. I obviously don't want to divulge specifics, but when you hear the same negative feedback from maybe 3 or 4 people that worked with someone at different periods of their life, understanding, there's 2 sides to each story, but when you hear the same story from 4 different people that don't know each other, that can really be enough to raise eyebrows.
I love to do back channel diligence. I laugh that this is the only business that you can trade on, private information. It's really great. And so if someone mentions in the meeting that, they have MasterCard in the pipeline and they're going to close them in the next couple of weeks, I have a call in to MasterCard and I'll ask. And we've had the case where certain people have said that things were close to closing in their pipeline and we called the customer and the customer said no. And we passed on the deal.
This is a critical point. We do background checks on full management team, plus Google searches. We spend a lot of time looking online and Glassdoor, all sorts of things. You sort of uncover things. And you as the entrepreneur or CEO, it's a good indication as to how deeply you've dug into your management team. I recently signed a term sheet with a company and we got into due diligence. And as we were diligencing the CTO, some really horrible things came up about him. And we went back to the CEO and were like, it was a very uncomfortable conversation and said, here's what we uncovered. Were you aware of any of this? He said, no. I'm like, well, we can't invest in this. And that guy was fired. It was a bad situation. But the point is that CEO hadn't done his homework. And really, we uncovered it by doing some search online. It actually wasn't even a big part of the background check that we spent a little bit of money doing. You can find the stuff online. So as entrepreneurs, if you're holding up a management team as a team that you think is backable, you should be doing your homework on them as well. Make sure that you're hiring the right team and you've done your background checks on your management team before you hold them out to folks like us.
Just generally important to just remember that it's a very small world, even smaller if you're in the New York venture community. And if you mentioned one, I've actually just last week was in a situation where a founder mentioned another fund and said they were planning to invest. And of course, like everybody does know each other actually. And I saw that particular fund manager that evening, and it turns out it wasn't true. But so it's just like, those types of things are just important to keep in mind, and
what happens with a enthusiastic yes when the meeting is good? What's the fastest timeline, number of meetings? What's it may happen and then it happens look like? And how often do you get a clear no, move on?
It's really hard for us to move any faster than sort of 3 weeks. That would be someone that we've known for a long time, or came through a trusted advisor or trusted source that we really like, or another fund that we've worked with a lot, and when it really fit perfectly in our thesis. And so 3 weeks is about the fastest. But I mean, to be perfectly honest, we like to know people for much longer than that. I try to give a person a no after an initial call if I can. But then if it goes into diligence, we find some issues, then obviously it's going to take longer.
Could always, a nice best practice to have is to just close any call or any meeting with asking what the process is and what next steps might be.
For some of the angel groups in the area, the process moves much quicker because it's not institutional capital. They don't have to go in front of credit committees and the like. You can probably get a deal done in 60 to 90 days, best case.
Common mistakes. I've just thrown a few here on this slide, but we've spoken about some, and there are others. Generally, VCs will not sign an NDA, especially early on. We talked about failing to properly research VCs. A waste of your time and theirs, but mostly yours. Spending too much time working with a VC who really doesn't seem to have much interest, and underestimating the amount of time and attention required. Raising venture capital money takes months from start to finish. Don't run out of time. Don't run out of money with your company. Leave yourself enough time. I don't know, other mistakes you guys would like to talk about, things on your mind?
I think one of the most common mistakes that entrepreneurs make, they don't understand why VCs say no. They haven't positioned their company to provide the return that a venture capitalist needs to justify for their fund. You have to show them, a 4 to 6x return and show them the path to get there. And I think that's a common mistake most entrepreneurs make.
Yeah, when somebody shows me this.
Oh, I was just going to say, the math for us, you also have to understand the size of the fund and the size of the check. And the reality of the early stage venture business is you're expecting many businesses to literally go to zero. So it's actually often not enough to underwrite to a 3 or 4x exit. It really needs to be something that feasibly could grow 10x by the time there is an exit. So I would, there's the vast majority of really great businesses out there probably do not have a 10x return profile, and that is more than okay. It just means that you might not be able to go to investors for whom that is a prerequisite for their investors.
I can't say how often that comes up. One of my clients, I'll see one of their a deck and look at their financials, and I look at the financials, and they say, we want to go out and raise VC money. It's like, you just, I'm not saying fudge your numbers, but I am saying that these are not numbers that are going to attract the interest of a VC. Doesn't mean that you may not hit them, and doesn't mean that this may not be a great business for you and for certain investors, but not for a VC investor that needs to be able to see a path to a 10x return. And so I'll say either take another look and see, or you got to find another way to raise your money.
This is such a weird thing, and I don't know how we all fell into this trap, but everybody has to show a deck that shows getting to 100 million in revenues in 5 years. And I don't know why that is. It's sort of this fairy tale. We all know that the numbers aren't real. We all know you're going to miss your numbers. But if you don't have it in your deck showing that you're going to be at 100 million in revenues in 5 years, it's sort of like you don't know what's going on. You don't know how to write a deck. You don't know how to present to us.
Yeah, a common mistake is actually in going out for venture capital funding is going for venture capital funding in the first place. Like the idea that there are so many companies now that are seeking venture financing. There are so many venture funds out now, and yet there are so few companies that actually fit the profile of that growth curve, right? So there are plenty of other ways to seek outside capital that doesn't fit that profile. Angel investing, different types of strategic enterprises, debt financing, but I think that's something to keep in mind.
I think valuation is where people make a huge mistake. Talk to a lot of entrepreneurs who are just simply delusional. Everybody reads the headline of this company, that company got a 10x, 15x, whatever the valuation is that they're using, and as soon as you read that, you as an entrepreneur think your business is that plus even better, and most people are just delusional when it comes to that stuff. Every once in a while, there are companies that have these outsized valuations. For every one of those crazy valuations, there's like 1,000 others that get financing at a much lower valuation, and everybody makes money, and it's good. So I think it's important when I meet with an entrepreneur who's just absolutely out of their mind, delusional, whether it's valuation or anything else, you got to look yourself in the mirror at some point and check yourself.
Area to New York, and there are the number of things you said in the panel which sound very different on the investment panel in the Bay Area.
Interesting.
What?
Tell us what.
I agree with him. I'm also, and I 100% agree with you.
I can pick three if you want.
Yeah. What?
On the valuations.
Yeah.
Oh, yeah.
Particularly get crazy and fight for dealing with pay no matter what.
Yeah.
Yeah.
It's a big deal. What you said about failing, typically, the market will
About what?
Failing.
A little bit earlier, you said, you look at how successful a founder
Oh, yeah, yeah.
I've been 3 times successful, 1 time a fail.
Well, that's okay.
Pretty good odds.
But 4 times fail is not good.
I agree with you on that.
Yeah.
But typically, that was a very strong point.
Yeah.
And I explained why I failed.
Okay.
On this one of
I give that to you.
So, and the other thing which is really different is when you pointed out in the presentation of products, like it's not important the product, it's a product, getting the product. If you look at all the major successes from the Bay Area and the founders, if you talk to them, they will only tell you, I built the best product and this is what I want. And that is not what VCs necessarily look for all the time, but the product I think is more important than the about what you said. Just a few examples.
Yeah.
So my question actually is, what would you consider is different or specific to the New York VCs towards the rest of the country, particularly towards the Bay Area? One of the things.
Yeah. Sure. So, like New York is fundamentally different from the Bay Area in so many ways, and my favorite way is that it's a tech and community, right? So everybody works in a different field, in a different vertical, and they're all tech enabled. Whereas I would argue that more companies in the Bay Area are tech first, and which is great because that's where the majority of the engineering talent is. But from a lot of investors' perspectives, it's perhaps more interesting to look at industry first and how that can be changed by tech-enabled solutions.
So I think the biggest difference is it's much sunnier out there. That's number one. Number two, I think just the size. So you have 300 VC firms approximately in San Francisco, you have 80 here. So that's a material difference, and you have so many more companies out there as well. But one of the things too that you need to think about is New York is a capital finance. We're focused on financial engineering. We're focused more on the deal necessarily than the product, where a lot of the VCs on the West Coast come from an operating background. And so obviously far more interested in the product. And that's reflected in valuations and what gets funded. So.
I just think an important point, I think what you meant on the slide of VCs don't care about product or tech isn't quite the point you were trying to make. I think the point you may have been trying to make is in a 30-minute pitch meeting, doing a 30-minute product demo and talking through each intricacy of the technology is only part of the story, right? Because eventually trying to understand the business is what the investor's trying to do. I definitely agree there's a huge difference there from SF to New York, but just wanted to clarify that one point on the slide because I don't think we really went over it.
There's no question that the product is vitally important. At the same time, there are many cases when it was not the best product that won the day. It was the second or third best product that had a great team behind it and knew how to deliver. So I mean, you can. But the point is, Sharla hit the point right there. For sure, you need to explain the product. It's got to be a good product. But don't spend 30 minutes talking about the product. Show them how you're going to take that product and blow the doors off and turn it into a business that's going to make them a huge amount of money.
I've made this point for years that New York and San Francisco are two totally different markets. And they look at the universe from two different lenses. I 100% agree with you. And I think what you're doing partially is kind of proving the point that you need to know who you're talking to and the lens that they're looking at your business through. And the way we look at your business may be very different than the way Kleiner will look at your business or somebody else. And I think that is critical. I 100% agree with you. Different markets, looking at things totally differently. I have conversations, when I'm talking to a company based in San Francisco, my conversations are almost entirely different it's like a different universe.
Yeah.
And that's okay. You just have to know your audience and who you're talking to.
And with that, we are going to have to wrap. Meghan, Alan, Tracy, Sharla, Barry, thank you so much. It's been great having you all. Please, at least some of the panelists can stay after, maybe answer some more questions. Leave a business card if you'd like to get access to the video or the slide deck or be on the mailing list. I'd also point out, we did a panel like this last year. It went much deeper into a lot of the details like alternatives to VC financing, really dug down on the different investment instruments, and a lot more of the details that we didn't have a chance to get to today. You can find that at least on my, Andy, is it on the NITEC website or? Yes? Okay, on the NITEC YouTube channel or on my firm's website under resources 2019. If you found this useful, you'll find that useful as well. Again, thank you very much and hope to see you all for a future event.